All right, so we're going to go over supply and demand entry methods. So how do we get into a position in the market? There are three ways that I look at it, and we'll go over each, and I'll show you examples. So the first one is tests of the current price zone. So by current price, we mean the price that's currently happening, the trend that is currently happening, the price movements that are now, not something when we look to the left of the chart. So what does that look like? Well, here on this up candle, this becomes demand. Okay. So a test of a current price zone, if we wanted to get long at this point in the market, would be a buy of this demand. And we see that holds. So that would be a current zone. So that zone, this zone here forms on this up candle. So that's something that's there. Then we come back and retest that imbalance area and hold it. So that would have been our trade. So what about what does tests of a historical price zone mean? Well, I'm going to back out to the hourly on the left here. We were looking at this demand zone on the hourly. This was about the 5,700 area on the ES. This is the NQ that I'm showing right now. But we have this candle. The full demand would be this full candle here. But I draw it to the close. So this is a strong, untested zone. Price has not come back to it. And it was a zone relatively at the start of our trend here. So this is a zone that I consider to be strong. So what we can do if we find a good zone like this, if we find a zone that we're extremely confident in, we could just put a buy order on that zone. All right, right here at the top of the zone, we could have a buy. Now, depending on if it's an hourly zone, that'll be bigger risk. But if you size down, it could totally work. That's another way to get into the market is with historical price zones. And the last way to get into the market using supply and demand is taking a prior bar high and low. So how this sets up is you wait until you're coming into an area of interest, such as this demand down here. Once we reach this demand, you are trailing with a buy order. The prior bars, we get into the demand of this bar, we trail the prior bars high. So it would be like this. We would see this. This bar would close. We would have buy one tick above. And the reason we have a buy one tick above is because once we start breaking the prior bar high, that's the first sign of an imbalance forming, right? We are taking out structure that's very tiny structure and it's very aggressive, but that's the first sign that something's changing. So we would trail coming into our zone, we would trail prior bar highs. This bar closes, this bar enters us into the market, and then we would have our stop just like with the demand that forms on this candle. Now this would act as our demand. Our stop would be below this low. That's an aggressive way to enter. Another way to use prior bar highs and lows is you can wait for price to show you the imbalance. So on here, on this up candle, we have this demand. Okay. I want to wait to make sure this demand holds. So how am I going to enter? I'm going to trail the retest of this demand. So prior bar highs, boom, boom, close here, drag it down, drag our buy down to this one, and we would eventually get into market on this candle. So there's different ways you can use it. You can tweak it. But those are the three entry methods. So current price level that forms a retest, historical price level that forms a retest, or using prior bar high and low breaks as a form, as the first sign that we're forming a new level. Well, let me know if you have any questions and stay safe out there.